So I have to say that the talk was supposed to be like a conversation between me and Chiho, but unfortunately he couldn't make it because of visa issues. So it's supposed to be like a fun talk, but now you have to bear me talking over myself. I do my best. So the talk is really about price discovery in cryptocurrency trading. I think Beto and Ignacio has done a great job, and Andrew, of course, setting the stage for decentralized exchanges. So I don't have to actually introduce from the scratch. But I just want to stress that price discovery is perhaps one of the most important functions for financial markets. By trading, by matching demand and supply, we know the correct prices for either stock prices, bonds, or cryptocurrency prices, which are actually crucial for efficient resource allocation, right? And one key question in financial economics is, where does the price discovery arise? Does it arise in spot market, or does it arise in centralized exchanges? So where is the information first originates? That's kind of the key question. As I said, it can be from different trading venues, from centralized exchanges versus decentralized exchanges, or it can happen across different assets. It can happen first in the spot market or derivatives. And the first set of questions, the research that we're trying to do is to answer whether it's actually the centralized exchanges or the decentralized exchanges where we see the price discovery first happens. And if it is happening on decentralized exchanges, what's the mechanisms for the information to be reviewed? Just to set a stage, because I come from more a traditional finance background, so I think it's helpful to first understand how centralized exchanges or traditional financial markets work in the first place. So if you think about LIC, Nasdaq, or Binance in crypto world, the trading is normally done first by a central limit order book. So you have all the quotes over there submitted by liquidity providers, right? You have the bids and asks. And if you want to buy, you hit the ask. If you want to sell, you hit the bids. So the prices information are submitted by the quotes. And what's more important is that trading is normally continuous, right? So you have this kind of schematic for a traditional exchange's match engine. So you have the match engine here, and all the traders here just trying to be as close as to the servers of the exchange as possible, right? So you heard stories of HFTs doing arms race, invest in speed technologies. I just read the news like 2 days ago, now they're building a microwave tower between London and New York. Just trying to cut down the latency and trying to be slightly faster. Because all it matters is the speed, right? If you can run to the exchange the first, you can trade ahead of others. That's how like trading on central exchanges happen. So you have to compete on speed, trying to be faster. But decentralized exchange is a different story, right? So here is kind of a graph showing you how trading is done on decentralized exchanges, for example, on Ethereum blockchain. So instead of competing on speed, as users or traders, you bid a fee, right? On Ethereum, you bid a priority fee. And the validators will see all the order broadcasted with the fees. They're going to rank the orders in a descending order of fees, right? And execute the orders first if you are willing to bid a higher fee. So essentially, you see that on decentralized exchanges, traders no longer compete on speed, trying to be faster, but trying to actually bid a higher fee to get executed ahead of others. So given the unique sort of trading mechanisms on DEXs, of course, the fee is a key factor here, right? So our first question asks, do priority fees review the information? Imagine yourself as an informed trader. What's your optimal strategy for the fee bidding? Should I bid a very high fee? And we've heard a story about front running. If you bid too high, you might signal to others that you're informed and just attract more competition. But if you bid too low, we know that the box space is limited, right? So you want to actually also execute as quickly as possible, just before the information actually slips away. So what's the optimal fee you should bid? It's not very clear. Do we see in the end informed traders bid a higher fee, or they can somehow hide their information by bidding a not too high fee? And if we observe that they bid high fees, what can be motivation behind it? These are like the two questions. First is yes or no, and the second is actually why. And the data we got is about trading in 4 different currency pairs, like Ethereum and Bitcoin. About the period, I think we expanded the sample now, but the baseline sample is actually about somewhere between November 2020 to February 2021. That's actually before the flash bots. So we got executed trades on both Binance and on Uniswap. These two are respectively the largest centralized exchanges and decentralized exchanges. And just to get the prices, we use the Binance order book updates so we can know the mid quotes of the different token pairs. And also we get Ethereum mempool orders so we can track the history of executed trade, right? When did it actually show up in the mempool? Is there any fees, adjustments made by the submitters, right? So essentially you can think of in the traditional exchanges way that you not only have the executed trades, but also the order submission history for that trade. I promise this is only math. And how do you actually know whether the fees contain private information? So what we do is kind of classical and traditional microstructure literature. So what we do is trying to first classify the trade flows you have on DEX into high fee, mid fee, and no fee. And to see that fee is informative, you just have to prove that for those trades with a high fee, they have a larger price impact. What do I mean by price impact is, whenever there's actually a large trade that is very actually surprising, showing up or executed, then you see that the prices on Binance respond to the trade, right? If it is only public information, we should see prices on Binance being already reflecting it without the need of trade, because remember that we have limited order books on Binance, so market makers can observe what's happening, like the news or whatever sources they will have, to update their quotes. So you don't have to rely on trades for the prices to move. But if we observe that the Binance prices responds to the trade, especially the high fee trades on DEX, that means the trade contains information that hasn't been reflected on the prices. And then what we call is private information. So essentially what we want to see is to calculate this kind of permanent price impact. Essentially when you observe a surprise trade to see how Binance prices responds to the trade. And that is actually used as a measure for private information in the trade. And here is like the key result. So the numbers here show you the price impact of the different trade flows. So for the low fee DEX trade flow, mid fee, and high fee. And you can see that the high fee DEX has a much larger price impact than the low fee. It's almost like 10 times more. So that means given the same sort of a surprise trade, if the trade is a high fee, that tends to move the Binance prices much more. And now we answer the first question, right? So we know that the informed traders beat the high fee for their trades. That actually makes those trades informative. And the second question, of course, is actually ask the economics question, why do they actually do so, right? Because when you think about why do they actually beat a high fee, there can be two rationales. First, they just want to actually avoid blockchain congestion because we know that blockchain can get congested at some times, right? When there's actually other activities, maybe not trading related, but other like NFT, auctions, or some ICO. So sometimes blockchain can be congested, and for informed traders, you just want to avoid being left behind, right? You want to execute your transactions as quickly as possible, so you have to beat a fee in accordance to the blockchain congestion. Or the second channel can be you face competition from other informed traders who might got similar signals with you, and they're going to compete with you on the fees. So in order to trade that information ahead of others, have to bid a higher fee than the others to trade. So it can be just a channel or a competition with your fellow informed traders. And what we find is, so I think just want to mention that if it is the first channel, that you don't want to bid a too high fee, right? Because your goal is trying to execute your trade in the next block. So ideally, we would like just to bid a marginal fee that can just get you in the next block. You don't want to actually be on the top of the block, right? If it is only due to congestion. But it's the second channel because you have to win over others. So essentially, you're competing for the location within the same block. So if it's the second case, you might see trades with bidding fees that are way higher than what's needed just to get on the next block, right? So essentially what we see is, so here is actually a very simple sort of classification to see if we see traders actually bid we call excessively high fees. So essentially, if you bid a fee that is above the 70% quantile of all the fees in the block, plus 1.5 times interquartile range, it is kind of like a standard way of detect outliers, right? So essentially, if your fee is above that threshold, we view you as actually bidding a super high fee. And if we do observe this kind of trade, then it's likely that it's not only the first channel, but also second channel exists, that you do actually face competitions with the others and sometimes have to bid a very, very high fee. In addition, we see that those trades are also actually very informed. So that's kind of evidence that it is informed traders who are actually bidding those high fee trades, not other arbitrageurs or sandwich attackers. And the last result I want to share with you is, if you think about informed trading, maybe you would think, okay, I need to hide my information, right? Why would I actually bid a high fee to review my information to the others? What's the rationale behind it? It seems to be very counterintuitive. So in order to answer that sort of surprising result, we dive deeper into the bidding strategies of informed traders to see how do they bid. I think this is actually a very kind of famous graph, maybe some of you will recall from the Flashpoint 2.0, that you might imagine because they bid in a public fashion, right, in the mempool. So you might actually start with a very low bid and observe other competitors' bids and then gradually bid up. So the first thing we check is, do we observe a lot of this kind of priority gas auctions in our data? But surprisingly, we don't. If you actually even zoom in on those trades where we identify as having a super high gas price, only about like a quarter of them, we see that there is actually a fee revision. That means they do engage to some extent this kind of priority gas auctions. For most of the trades, they only show up once in the mempool, and they get executed. So that means the traders, they actually place a very high initial bid instead of testing it out by placing first a low bid and then gradually bidding up like the graph here. And we look at the literature, it actually fits a kind of very well documented a jump bidding strategy in auction theory. So jump bidding just means you bid for your first round already a very, very high fee. And the reason for jump bidding is if you can signal to others that you are a high value trader, that you want to really get the trades done, you can signal to the other competitors not to compete with me, because if you actually engage in the competition later on, there's no way you can win over me. So you can just drop out. So I think this is actually kind of an economics rationale we find in our paper, that informed traders, they use jump bidding strategy to convey to other competitors and discourage competition. And this is the part I would do for Chi-Hong, because the first question is really about like centralized exchanges versus decentralized exchanges. And here the second set of questions is more about spot trading, think about cash trading versus derivatives. So we have a special type of a futures contract in cryptocurrencies trading. It's called a perpetual contract. It's like a futures contract in traditional financial markets, but without expiration date, right? So normally for futures, you have like 1 month, 3 month expiration date. But for perpetual contract, there's no expiration date. But what they do is to have a funding rate mechanism. Essentially, it's like the cash settlements of the futures contract when it expires, right? But now the settlement happens every 8 hours. So if you're actually the sort of the alongside of the contract, and if the if the price of the perpetual contract is actually higher than the underlying spot, you have to pay a fee to the short side. So by this kind of a funding rate mechanism, you ensure that there is a convergence of a spot and future prices. And the question here essentially asks, we have 2 different assets you can trade the same information. Where would you want to trade first, right? So Chi-Hong's paper, okay, we'll skip the methodology. Essentially, it's still within the VAR model, and that method can help you identify where do the prices move first, right? Does the price first moves on the spot market or is that in derivatives? Essentially, that's the question, where does the price change happen first? And can use this kind of factor error correction models to identify that. And I think this is a key or signature graph of their paper. So here is actually the information shares you can calculate for the for the information origination. So you can see that the blue bar here is the information share of the perpetual contract. You can see it's much higher than the spot. So they just show you that information originates first from the spot. And given interest of time, over the last minute, I was just trying to conclude. So I think the price discovery in DeFi or cryptocurrencies trading in general is interesting because we do have very unique market structures, right? You have different exchanges, centralized, decentralized, and the trading mechanism of decentralized exchange is very unique through the fee bidding mechanisms. And also you have different assets you can trade, right? Especially if you have a very special type of asset like perpetual contract. So you can trade theoretically across different venues, across different asset classes. So I think it's actually interesting to look at all this kind of different trading landscape to see where the price first actually changes or first reflects new information. And open question I pose here is actually, our papers are actually both about price discovery, but we do know that for market quality, we also care about liquidity, right? Normally, if you have too much informed trading, that's actually not good for liquidity providers because they are more likely to be ever selected. So how can you actually design optimal market structure to balance these two things, right? On the one hand, you want to actually better price efficiency, and the other hand, you want to actually have a better market liquidity. And I think it's actually interesting to think about what can the future designs be that can have actually a very good balance between these two. Yeah, that's all for my presentation. Thank you.